Strive not to be a success, but rather to be of value. This is surely one of my more favorite quotes from the well-known Albert Einstein. When you aim to provide value for others, success is inevitable and likely long-lasting as well. After years of engaging with so many of our boutique managers, I believe this to be true of most of our managers, if not all. And Centaur Asset Management is definitely no exception to this. Good morning to our wonderful audience and welcome back to Boutiques on Wednesdays. Always great to have so many of you and a lot of you that we know over the past couple of years joining us again. Centaur Asset Management is very focused in managing two mandates, the Centaur BCI Flexible Fund and the Centaur BCI Balanced Fund. Joining us now from Centaur Asset Management is Nick de Vos to share, among other things, their take on China and SA outlook and positioning. Good morning, Nick. Thank you so much for your time this morning. How are you keeping?
Morning, Eugene. Very well, thanks, and you?
Great, thank you. And Nick, if you can start by sharing your screen. And while you're doing that, and not to steal your thunder, as part of the presentation this morning, I do believe you are soon to launch an SA equity fund amidst all the negative sentiment in and around SA. I find this very interesting, and I'm very keen to look at your views, especially on that of SA.
Okay, great. I'll touch a bit on it in the presentation.
Fantastic.
I think it's the second last slide. And then next week, also Wednesday, I think it's around next week, Wednesday at 10 a.m. we've got a session. I think you guys might also be hosting it, where we're going to be talking about the SA equity fund that we're launching.
Yeah, great stuff.
Okay. Can you see my screen?
Yes, perfect, Nick. Thanks.
Okay, great. Should we kick off?
Ready when you are.
Okay, great. Okay. Thanks everyone for joining us. So I'm going to be discussing a couple of topics today. So, as Eugene mentioned, I'll give you a little bit of our views on China and how we see it at the moment. But on the luxury sector, which is quite interesting at the moment. And then, I'll talk about our current positioning, outlook, and a bit about SA. But, firstly, for those of you that might not be familiar with Centaur, the business is now 23 years old. So it was founded in 2000. Three guiding principles: investment excellence, which is really performance. I'd say that's the main thing that we focus on, with outstanding service and, without saying utmost of integrity. We are a retail-only asset manager, which means we don't take on any large institutional or pension mandates. And our AUM is currently just over 7 billion rand. And then we have a tightly knit team where everyone's very aligned with the performance of the funds. So this is just a chart that we show. It's the long-term track record of Centaur that's delivered. This is after fees, around 7% per annum. And, original investors that started out with Centaur are now almost up 50 times on their original investment. So, this year has been quite a good year for us. I was looking this morning, the market did bounce a bit yesterday, but we're up about 15% in the flexible fund and around 13% in the balanced fund year to date. This is just the longer term track record of the flexible fund. It's number one over a 10-year period in its category. And this fund's now around, I think, 20 years old. It's won numerous awards over the years. And I think what's quite interesting is if we look at the balanced fund, it's only won that single Raging Bull in 2016. And this, I think, really reflects kind of our process. We're not aiming to be, the number one or two fund in any given year. It's really, if you, look over a longer time period, if you, stick to the process, that over a tail, you should move closer to the top of the rankings. So number 2 out of 84 over that 10-year period. And over 1 year, 14 out of 219. And I just want to say, I don't envy any of you on the call picking out of 219 different funds. I mean, that's more shares than that, that are investable on the JSE. In terms of our philosophy, So this is just a phrase that we've coined ourselves. It's called dynamic value creation. So there's really 4 elements that we look for. First and foremost, it's a strong management team. So that's what you'll see in any large investment that we make. It will typically have a management team that we think are dynamic value creators. We're looking for good businesses that are evolving and really growing value or growing the pie. We're not going to invest in a business just because it's cheap, or make a meaningful investment in a business just because it's cheap. You buy something on a 4 times earnings. If the pie is not growing, it's still going to be on a 4 times earnings in a couple of years' time. So just an example on dynamic value creation. The example here is RMB Holdings, which unbundled RMI and essentially OUTsurance in 2011. So typically we look at these unbundling situations as a special situation because sometimes there's an overhang in the shares where holders that get the stock tend to sell it, and that creates a bit of an opportunity. But RMI, we identified value creators: Laurie Dippenaar, Paul Harris, GT Ferreira. There was a hidden asset in this business called OUTsurance, which we still hold today. We think it's a fantastic business. It generates very strong returns on equity, very good cash flow. And at the time, it was growing revenues in excess of 20% per annum. So in 2011, that's when we bought the initial stake in the funds, and it was a maximum holding that we took. So we took it all the way up to 10%. So, how did that perform over the following years? So, they've grown gross written premiums by 14% per annum. This is over a 13-year period. They've been very successful in Australia, a business that now comprises more than 40% of gross written premiums. They are also establishing new growth nodes. They recently entered the market in Ireland. We think that's going to be loss-making for a few years, but eventually we think it will, add to the profitability of the business. In SA, they're also now entering more of the corporate space. Traditionally, it's been more of a retail consumer-facing business. But the corporate market is larger than that existing market that they're in. So we think that could be quite exciting. And then in September 2022, they also unbundled Discovery and MMI. We've sold completely out of Discovery, but we still hold MMI, and we actually have topped up on it a little bit at good levels. So over the period that we've held it, it's done 20% per annum versus the market that's done 11% per annum. But I think I'm just cautious. At the moment, we have been trimming a bit of OUTsurance. We think it is quite full here, but still an exceptional business. So just on the luxury theme, I think this is quite topical at the moment. We've seen a lot of the businesses in the luxury space down 20-30% from their highs. But this chart on the left-hand side just shows you that it's a structurally growing industry. So this illustrates that it's been growing at 6% per annum since 1996. I think 2022 is a bit of a high base. So what's the reason for this growth? So if we look at business that we're locally all very familiar with, Richemont, that's been growing at 10% per annum, both over a 10-year period and over a 20-year period. So, what's really driving this growth is the fact that branded luxury goods are still small in the overall pie of luxury. So it only makes up 30% of jewelry sales. So there's a lot of, not only is the jewelry sector growing, but there's scope to take market share, which amplifies that growth. These businesses also have pricing power. They're known as Veblen goods. So the more you increase prices, the more aspirational the product becomes and the more consumers want to buy it. There's also demographic tailwinds and a rising international middle class, specifically out of China, where, pre-COVID, around about 40% of Richemont's sales were going to Chinese nationals. And then, just in terms of pricing power, if you were on the Richemont call last week, I'll just point out, Rupert made a comment saying, and we'll touch on it a bit now, but, coming out of COVID, a lot of these businesses increased pricing very aggressively. So they've brought a lot of that growth forward. So, over the next year or two, I don't think we would expect pricing to increase at the same clip that it has done in the past. So, this chart here on the right-hand side is an index that we've created of the luxury sector, and it just shows you what we've been going through, since COVID. So you had that COVID drop-off where sales were down 30%. You had the whole world locking down. And that created a supply chain shortage in a lot of industries, and the luxury sector wasn't spared. But that was actually a good thing, because it created a shortage of the product, and then pricing power took over, and there was a lot of demand for products. There was stimulus globally. There were essentially helicopter money that was going around in a lot of geographies, and off of a low base, sales rebounded 60%. But what's important is, since that high point, quarterly on quarterly, sales have been slowing, and more recently, sales have actually now turned negative. And this is typical of the luxury industry. I think not to the same extent or extremes that we've seen now in the recent history, but it is a cyclical industry that does go through cycles. And the market often misprices that, and you're able to trade that. Okay, so on the right-hand side here, we have a very simplistic picture, but it's an index that we've created. It's price to sales. Typically, everyone always shows price earnings, but I'm showing price sales here specifically because to remove the operational noise that goes around in businesses. And you've seen there's been recently been a very sharp drop-off as the market's been pricing ahead of time the slowdown in the luxury sector. And frankly, China hasn't rebounded to the extent I think that people might have expected. Richemont's down about 30% from its highs currently. And we think that this kind of drop and the structural nature of the industry that's growing, we think it meets that dynamic value creation criteria, and it's a sector that we're busy looking at. We're looking at Richemont, and we're looking at a couple of the offshore names currently, potentially entering a position. So, I mentioned that Richemont's quite exposed to China, and, a lot of SA businesses, especially the miners, are exposed to China. And, something that a lot of market pundits have been talking about is whether China is facing the same situation that Japan did in the early 1990s. So just some context, you had in the 1980s, you had a debt-fueled asset bubble in Japan. They also had a very elevated property market. And at the start of the 1990s, that bubble essentially popped. You had land values and equity markets dropping by around 60%. So China is currently facing a similar dilemma on the property side, but maybe what's a little bit different is that the Communist Party is artificially kind of forcing or keeping home prices at a level. So you aren't allowed to go and discount the price of your home to sell it. What we're seeing is that volume's actually dropping off. So the guys that are bearing most of the brunt, actually the developers who are seeing volumes collapse. So that's a bit different to what the Japanese had, where they had volumes and pricing collapse. Also, what's similar, very elevated levels of debt in the system. In China, it doesn't really sit at the state level. It sits at SOE level or at regional government level. And also they have an aging population. It's actually aging at a faster rate than what the Japanese population was aging at, but it's actually at a similar level. So the age group 65 and older, it's around 13% of the population, which is similar to what the case was for Japan in the 1990s. And then there's this deglobalization theme that's now been happening post-COVID, where a lot of Western countries are bringing manufacturing capacity closer to their own shores. And then there's a lot of geopolitical tension. Since the Trump era, there's been trade wars between the US and China. We're seeing what's going on in Israel, Middle East, Russia, Ukraine, and then I guess probably a big risk is if anything ever happens with Taiwan. So here I've given you a couple of headlines on the left-hand side, and this is really the point I want to make from all of this kind of like China. In 2008, The Economist was already talking about a property bubble in China. Below that, you've got Jim Chanos, which is a famous hedge fund manager in the US, was calling for a collapse in the Chinese property market in 2010. And then more recently, there's an article talking about China attempting to deflate an unstable property bubble. And that was, I think it was 2011 as well. So, I think, if you had asked me probably a year ago or told me that the Chinese property market was going to be in the current situation, I would have told you that the iron ore price would probably be a lot lower. And that's why I've got the picture on the right-hand side. So this is BHP Billiton, which earns the vast majority of its revenue from iron ore. So it's more than 50% of their revenue comes from iron ore. And why iron ore is important is that Chinese property market consumes north of 40% of the global seaborne iron ore demand. So, if you look at where the chart starts, that's when The Economist article started, but that was the GFC. So BHP Billiton halved. But then from that point in time, had you listened to all the market commentators telling you about the impending collapse of the Chinese property market, BHP Billiton's up over 8 times in rand terms over that period. So, I think that the point of all of this is that we aren't and we don't make big macro calls on any specific factor. We're concerned about China, but we're not going to go and make a big call on whether or not the property market is going to completely collapse or not. We don't also make calls on whether the market overseas is going to imminently collapse or not. The problem with this is you might be right, but you might be right in 5 or 10 years' time, which essentially means you're wrong. So this is the flexible funds current asset allocation. It's quite a similar theme over the past year. We're still underweight equity content, so we're carrying 69% versus our benchmark at the 80%. In terms of local equity, we are 46% versus the 60%, so quite a bit underweight. But we are turning more incrementally positive on SA. I'll just point out that we do often substitute a bit of our SA equity content with offshore holdings. And then in terms of the firepower that we currently have, we've got that 18% in local cash, and we've got the 7% in offshore cash, which gives us 25% that we could quite quickly deploy if needed to. This is just the long-term history of the asset allocation in the flexible fund, and you can see that cash and cash equivalents is kind of at a similar level to that 2014, 2019 period. And then when we went into that kind of post-COVID period, that's where we really went overweight equity content, and then we started bringing that back just over a year ago. So more defensively positioned. Our SA outlook. So I think it's very fashionable to be negative on South Africa, and I think it's difficult to argue against that. I mean, we're constantly bombarded with negative news headlines. I've put 3 here that are positive, that I think are structurally positive, that are often glanced over. Probably the most material change that we've seen over the past few years is that the private sector is getting more involved. The government's facing a bit of a fiscal dilemma where they're running out of money. So they're kind of forced to bring the private sector in. It's a bit of like a chicken and egg. The worse things get, the more the private sector is getting involved, and probably the more positive the longer term story would become. So we are seeing a few structural positives, especially on Transnet, and I think you've all probably heard about Eskom and renewable energy. We think that's also a solvable problem. We're seeing a lot of fixed investment across the country. Business that we follow, WBHO, sitting with record order books in South Africa. I think there is a bit of an element of market share gains there, but if you talk to guys at Afrimat, they're saying that across the country they're seeing some element of construction activity happening, and usually you can pinpoint one specific large project in the region, but this time around it seems very broad based, which is quite encouraging. There's a lot of renewable projects that need to come to market, and especially on the water infrastructure side, that's probably might even be a bit of a bigger risk than the electricity side, and there's a lot of spend that needs to happen on water. I think generally we think future economic growth will be a bit better than what it's been over the past 5 years. The country hasn't really been growing. It's about 0.5% per annum. We think the next 5 years, not going to shoot the lights out, but we're saying maybe 1-2% GDP growth, which isn't enough. But at least that's a bit of a tailwind that SA equities will have that we haven't had over the past 5 years. And then we are finding a couple of exciting SA Inc. Ideas currently. So this is just the forward PE of the SA market. You can slice and dice this a number of ways because, there is a large Rand hedge component here. There's a mining component within this. But essentially, the sector is trading at, or SA is trading at about a 25% discount to history. But there are specific SA Inc. businesses which are trading at much larger discounts than that. Then, as Eugene mentioned at the start, and myself, we are going to be launching an SA equity fund. I think it is going a bit against the grain, with the Regulation 28 changes that we've seen. Everyone is moving money out of the country, selling SA shares. I think if you look at the kind of like high equity balance mandates, sitting just shy of 40% offshore exposure at the moment. That's up from around 30% a year or two ago. So guys have been taking money out of the country. Foreigners have also been selling SA equity content. And, I think a risk that you face, there's always there's an asset liability mismatch that you face. In early 2000, everyone was busy taking money out of the country, and then you had a period where the Rand significantly strengthened. We were talking to a client the other day that was telling us about one of their clients who took money out kind of at the worst moment in 2000, and it took them 10 years to break even again in Rand terms. So that is just always a risk that you face. This slide here specifically talks about our SA equity component within the flexible fund. So we've gone and stripped this out. So over the past 5 years, we've managed to outperform the cap SWIX by around 6% per annum. We can go and pull this out further back. We've got much longer history than this. But I think the point is we have an ability or proven ability to outperform in this space, and we think it will be a good building block or additional product to the Centaur suite. So in summary, I think we continue to deliver good returns. It has been a good year for us. We continue to be defensively positioned, but we are still finding opportunities. I think the luxury sector does look interesting. The Chinese economy is on shaky grounds, and it does concern us. But we're not going to go and take any big bets around that. And then, as I just mentioned, we are also going to be launching an SA equity fund, which we are quite excited about. Next week, Wednesday, I think it's 10 o'clock, where BCI will be hosting, and we'll be going through that fund specifically. And here's all the lovely disclaimers for you guys. So that wraps up my presentation. Thank you.
Nick, thank you very much for that. And just to touch on that, what you mentioned as well, next week, Wednesday at 10, I know the BCI marketing team did circulate some invites on that, also online session. If you did not receive it, then make contact with your BCI team member or Olga, myself, and we'll get those invites through to you as well. To discover a bit more on your SA equity fund and why SA equity. Nick, thank you very much for this presentation. Just very quickly, I don't see any open questions from the audience. You're more than welcome to post questions. But just from my side, if I look at your benchmark of the flexible fund, which is your flagship fund, it's 60% cap SWIX or SA equity, 20% MSCI all country or global equity, and then 20% STEFI or cash. More specifically, if you look at tactical asset allocation in your fund, does your composite benchmark anchor the fund's positioning at all, or do you move around that? And how cognizant or how aware are you of what peer groups or similar funds are doing around you?
So the benchmark in both the flexible fund and the balanced fund is essentially our strategic asset allocation.
Yeah.
So, how we go and build that up is we build an efficient frontier, and you go and make forecasts, and you come up with what's the best risk-adjusted asset allocation for the fund, and that's essentially the benchmark. So that's your strategic. Tactical asset allocation, we've got a few internal tools. There's one that we often show in presentation. It's the interest rate cycle in South Africa. And that really guides our tactical asset allocation around that strategic benchmark. I want to say what outweighs that, if we find a business that we think is very attractive, that's north of a 20%, or depending on the business, north of a 20% IRR, we'll go and weigh that up, and we'll go and buy that, I think irrespective of what kind of that tactical asset allocation is. So that guides you, but first and foremost, it's really bottom up.
Yeah, makes a lot of sense. I want to we're going to unpack that a little bit more, but just in terms of your numbers, some impressive numbers that you showed in the beginning of the presentation as well. 3 years, almost 14% average per year, 5 years, 9.6, 10 years, 9.3. I know you've got a composite benchmark. I spoke about that now, but in previous presentations, you always also alluded to the fact that, if you look at if you were to put a real hard number on the portfolio as a return objective, you're probably targeting roughly about inflation plus 5. If I look at your historic numbers, you're actually delivering on that, unlike, a lot of other funds out there really struggling with that. My question then is, do you think inflation targets like inflation plus 4 or 5 is still realistically achievable over the next, 3 to 5 years in mandates like this?
Well, look, I mean, I think it should be. If you just look at the fixed income market, if you go buy a SA 10-year bond, you're already going to be getting CPI plus 5. So that's quite a good starting point. We've managed to deliver it. I think over short time periods, it's difficult to do exactly a CPI plus kind of benchmark every time. If you go through like a GFC, it might take you 3-4 years kind of for like equity markets to catch up on that. But generally we're trying to buy businesses where we're getting about a 20% IRR, and that should typically beat kind of like a CPI plus kind of like mandate. That doesn't always work out at 20% per year. That's kind of like what you're targeting when you buy a business, but reality does play out a bit differently. But yeah, I mean, it should definitely be achievable, especially if you look at where the kind of like fixed income market's sitting at the moment.
Great to know that, because I think we all worry about that from time to time, especially in high levels of volatility. I think very relevant to SA investors, and this being a flexible mandate, you can go 45% offshore. How much international exposure do you think, at this point of time is appropriate for a mandate like this? And again, from an SA investor perspective.
Yeah, it's a very difficult question. So in the flexible fund, we've got around 30% offshore at the moment. In the balance fund, we've got around 25% offshore, which is quite a bit less than I think the average balance fund is sitting, especially like the larger guys. They're all sitting maybe closer to 35, kind of like plus. We're going to invest where we see the opportunities. We've got that strategic asset allocation that we kind of move around. In the balance fund, it's a bit lower. We've got about 16% MSCI World that we target, so we are like technically overweight that at the moment. You just need to be cautious of that asset liability mismatch. Maybe speaking from the balance fund perspective, we've got a lot of investors in there who are, they're South African based, investing for an SA retirement. I think we're just a bit cautious about taking all of that money out of the country, especially now when we're turning more positive on SA. Not saying we won't go to 45% overseas in time, we might. It's just not how we see things at the moment. We do have a bit of a preference for SA.
I tend to agree with that. I mean, you need to look where those liabilities are, most definitely, and not just a shot in the dark and run for the hills because of sentiment. Let's stick to SA equity. I mean, in the flexible fund, again, you've got a healthy exposure to SA equity. You're also launching an SA equity fund. But if I look at SA bonds at the moment, yields trending at roughly about 12.5%, very attractive indeed, giving clients easily inflation +5. We all know that doesn't come in a straight line, most definitely. But if you weigh up SA bonds relative to SA equity, it seems that the equity risk premium is just not there. Why still a healthy allocation to SA equity if bonds can perhaps do the job?
So I disagree a bit with that. So look, you have to hold those bonds to maturity. So there's kind of like a reinvestment risk in that.
Not a zero-sum game. I fully agree with that.
And so let's talk about this from the balance fund perspective, because that's where bonds are maybe more applicable. So we're sitting right on where our benchmark is, 25%. Like recent history, it's been a little bit underweight because we have been quite concerned with the fiscal position that the country is in, and that can play out in numerous ways. So that very good real yield that you see, it's a very good real yield for a reason. Now, you can't just look at it and say, geez, well, things are very cheap. That being said, we don't go and take very big bets on the fixed income side. I think our skill set really lies in equity, and if we can find a business that is going to give you SA equity, kind of like smaller mid caps that can give you 25% plus IRR, I think over any 3-5 year period, that's going to outperform what a bond does. The reason for that is that business, the reasons why over the longer term businesses outperform bonds is because they've got a lever that bonds can't pull. They can go and take excess capital and reinvest that in the business at a higher rate. So, look, we hold bonds, but we're using it as an asset allocation tool. We're not our real skill set sits on the equity side.
Makes a lot of sense. And I mean, if you look at the narrative around SA bonds the past 12 months, a good example how a lot got it wrong. But I'm not going to dive into that. I'm not going to digress on that. Back to global equity. And you did speak to, what you look at when you do your strategic asset allocation and tactical as well. Does currency ever play a role when you do make a call on your tactical asset allocation to global equity?
It doesn't really. I'd say we're aware of it. So we actually I don't think you can accurately forecast the currency, but we do have a model internally. So we look at purchasing parity, and we've got a model that has historically worked, but it started breaking down when we had the downgrades to sub-investment grade. So we have a view on the currency, but that kind of just complements the existing research process. If you had to go and make a list of kind of like factors that we're looking at in businesses, currency's quite low on that list. It's really more about the business model and the nature of the business and how they're creating value.
And that opportunity set that comes with that, obviously, as well. Yeah. Nick, on the global equity that you've got there at the moment, what is that pond you fish in? Do you only look at developed market or US equity, or would you look at things like emerging markets in North America? It also speaks to one of the questions from our audience members.
So we predominantly focused on US and Europe. We try and stay away from opaque regions where it's difficult to understand what's really going on the ground. We find like a market like China always feels like you're a little bit on the back foot. You look at a business there, the share starts moving, and you think it's an opportunity, but meanwhile the guys that are on the ground there have some insider knowledge, and something's busy going wrong in the business. There's a couple other reasons why we're quite wary of China. We will invest there, but we're very cautious when doing it. So predominantly we'll stick to the US. It's the US is almost like too capitalist. So it's a market where like value creation can really thrive. Europe is somewhere in between, capitalism and socialism. And then China is kind of like murky.
Yeah. But especially with a lot less data points coming out of China, probably a bit like our government. If you don't like the data, then just don't speak about it. So interesting indeed. A question from our audience as well on your offshore equity. Can you maybe speak to one or two ideas that you have in the fund that excite you?
So, our largest holding is Exor. So it's a holding company. It's trading on quite a big discount. John Elkin is at the helm of that business. We think he's a value creator. One of the nice things about businesses that trade at big discounts is they can continuously buy back shares. So that's a kind of like an easy lever to grow your net asset value per share. So guys always say like a permanent discount doesn't look like a good thing, but it's a easy lever that management can pull. They've got exposure to Ferrari, which we think is an exceptional business. They're sitting with quite a bit of cash on the balance sheet, and it's really a management team that we back. I think they've managed to grow, from top of my head now, about 16% per annum, kind of like compounded annual growth rate over the past 10 years. So Exor we quite like. Another business that's come back quite a bit now, that's starting to look a bit more interesting. It's an existing holding in the fund, is Flutter. What we really like about that business, so it's a global kind of gambling, but really iGaming, sports betting business. What we really like is FanDuel, which is a business that they have in the US. And what's happening in the US and really globally is that markets are starting to become regulated. So these regulated players are then able to enter, more and more states. They've got an existing platform. You plug that into, newer states as they open up. You do that at a very low incremental cost of capital, or very like it's not a lot of new capital you have to put in because you already have that existing platform. I think we think that business can grow as the US starts turning more profitable, 20-30% per annum. And the share has come back quite a bit of late, so it is looking a bit more attractive. So there's two.
Yeah, Nick, I think that's two very good examples. The Fed, again, sending mixed signals over the past 3 weeks. We can see it from market reactions as well. They did pause and then they come back and say, but there may even be another rate hike. Who knows? We're all data dependent, like the Fed, so pointless in making calls on macros that we can't call at all. But nevertheless, higher or high interest rates for possibly longer, obviously increase in cost of capital, draining liquidity from the market. So whether it's going to be a hard landing, soft landing, no landing, who knows, or Goldilocks scenario, I don't know. But surely a lot less liquidity in the market, higher cost of capital will have an impact on growth and earnings of a lot of these companies. You've mentioned two examples. Are you concerned about that? And how can this potentially impact on some of those offshore holdings that you've got?
So, we are concerned about it, and that's why we are underweight. One of the reasons why we are underweight equity content. I think the US has held up a lot better than what we would have thought. There's been a lot of excess kind of savings in the system that seems to now finally be working its way out. On the fiscal side, monetary policy has been tight, but on the fiscal side, they've actually been set spending. So the two have been offsetting, each other to some extent. There's excess savings are starting to, the consumer sitting on is starting to work its way out of the system. If you look at a lot of the company results, everyone's starting to talk about things slowing down. I think there's a bit of a high base in that, but things are starting to slow down. And then, if you historically look at it, the Fed's always overextended. Because they're looking at backward-looking data.
Yes.
So historically, what's happened is, they hike interest rates. They get to a point, maybe they pause now or not. I'm not sure. and then something in the market tends to break, and that's usually when they start aggressively cutting interest rates. So, this market move we've seen over the past, well, let's call it yesterday, where inflation came in 10 basis points lower than people were expecting, and the market went and rallied on that because the market's saying the Fed's going to start cutting interest rates because they've got inflation under control. But historically, it hasn't played out that way. I mean, you can look at every single cycle. It's usually this overextension of the Fed on the way up, and then they have to quickly self-correct while the economy slowing too quickly. So, it's very difficult to call if that's going to happen or not, but historically, that's kind of how things play out.
No, most definitely. Perhaps the last question from my side. I see there is a question on SA equity and some of the opportunities and how you're going to position for that. But I'm going to leave that for the 22nd of November when you do your launch on the SA Equity Fund. I'm sure a lot of that will be covered in that session. But maybe just on the last point, in the short to medium term, what risks do you worry about most in your portfolio, specifically the flexible mandate?
Look, I mean, there's always a lot of risks. I think geopolitical, let's talk about the things that are first out of our control and then maybe in our control. So, geopolitical is always a risk. I think, if Taiwan were ever to be invaded, I mean, that will be, kind of disastrous for the global economy. If things in the Middle East escalate, there's risk that kind of like oil price, I guess this will benefit us actually, because we have quite a decent position towards the energy sector. But if oil prices spike, if the Middle East things escalate, it's really Iran that would where potential supply could come out. It's not that big; it's only 2-3%. There's a bit I can go in on that, but in the interest of time, I won't. But then risks that are kind of like in our control. It's really if you make like an analytical mistake. I mean, that's kind of what you worry about. What what you don't want to do is you don't want to be invested in a business and then you go into a drawdown and then you realize actually our thesis isn't working. You're down 20-30%, and then you have to sell something. What you want is where share comes off 20-30% and you still very confident about your view and the research that you've done, and then you're actually going to buy more of it. So it's that risk. I think an analytical risk that's in our control. That's probably what I worry about the most versus things that are really outside of our control. And we've set up systems in the background in terms of asset allocation that there's different parts in the cycle how we manage things that control, but for those risks that are outside of our control.
Yeah, Nick, I'm gonna finish on that point, and I mean it's very valid. We all know the past 5 years, especially the past 3 years, been topsy-turvy for everybody. But just looking at your numbers, what you spoke about now is that process, and it's clear from your numbers that the process is actually working. For investors out there and intermediaries looking at clients' assets, if you're looking for somebody to make that flexible asset allocation calls for you, definitely a fund worth considering, plus the balance in the Rec 28 space if you want to look at that. Quick reminder, next week, Wednesday, 22nd, the morning, we still have boutiques on Wednesdays with New Road Capital. And as Nick mentioned, I mentioned that as well, 10 o'clock on the 22nd, also next week, Wednesday, Centaur speaking about the SA Equity Fund launch, and they will most likely unpack a little bit more details on where in SA they see those opportunities and why you're launching an SA Equity Fund at the moment. Nick, it's been absolutely great having you with us. Thank you so much for your time. And to our audience out there, thank you so much for joining us. The BCI team, Tanya, Olga, thank you for arranging all of us. Always great to have these kind of sessions. Nick, we'll chat to you very soon again. Thank you so much.
All right. Thanks, Eugene.